Hi, and welcome to the second and final module of our course on reading financial statements. The purpose of this course is to help you read a company's annual report, including how to read a set of financial statements. In the first module, we started with the balance sheet, along with the related notes to the financial statements. In this module, we take you through the income statement and statement of cash flows, and conclude by covering the key contents of an annual report. We use Espresso Software's 2018 annual report and financial statements to demonstrate the key concepts. It's time to get started, so let's begin. As a reminder, there are three key financial statements: the balance sheet, also known as the statement of financial position; the income statement, also known as the statement of operations or the profit and loss statement; and the statement of cash flows. Module 1 gave a complete overview of the balance sheet components. Let's now explore the income statement in more detail. We'll explore the statement of cash flows next. The income statement, also called the profit and loss statement or the statement of operations, contains the transactions of a company for a period of time. As you already know, the income statement starts with a zero balance at the beginning of a fiscal year and contains all of the transactions affecting revenues and expenses throughout the year. At the end of any period, it summarizes the amount of revenue earned, expenses incurred, and the net profit after amortization, interest, and taxes are factored in. Therefore, the importance of the income statement is in showing the profitability of the company. However, there are different approaches to showing the profitability on the income statement. The income statement can be presented using either a single-step or a multiple-step methodology. The single-step income statement groups income items in one section and expense items in another section. Profitability is not shown until the very end, where net income is displayed. The multiple-step income statement separates out income and expense items into components to allow for profitability to be displayed at different stages. Direct revenues and direct expenses are first shown to arrive at gross profit. Indirect expenses related to operations are then shown to arrive at operating income. Any other revenues and expenses, including gains and losses, are then shown to arrive at pre-tax income. Income taxes are then displayed to arrive at net income. Let's now look at some of the line items of the income statement that need a little more explanation. Directly below revenue, we will usually find cost of goods sold. Cost of goods sold may also be referred to as cost of sales, which is the description normally given in a service-based industry. For our purposes, we'll stay with the description cost of sales. Cost of sales may be shown as a summarized line item, or it may be broken down into its individual components to arrive at a subtotal. Those individual components are the expense items directly related to the production of the good or service. For example, in order to manufacture a good for sale, there will be the cost of the raw materials, as well as the production costs to turn the item into a finished good. These costs are allocated to inventory on the balance sheet, but when the inventory is sold, it's transferred to the income statement as an expense item. In order to deliver a service, labor costs are incurred in the delivery of that service, and those costs are directly allocated to cost of sales. There may also be other allocations, such as overhead, that are directly related to the production of the good or service that would ultimately be included in the cost of sales figure reported on the income statement. Another line item commonly found on the income statement is the line titled Selling General and Administration, or SG&A. SG&A contains a large number of expense items that are all grouped into one line item on the income statement. Examples of expenses include advertising and promotion, professional fees such as legal, insurance, and accounting, office supplies, rent, and other related expenses. As you can see, all of these expenses are related to selling activities, administrative activities, or other activities that aren't directly attributable to the good or service being sold. One final income statement item to draw your attention to is related to gains and losses. These may be shown separately or may be grouped under other income and expenses and appear after all operating items are presented. Gains and losses are related to activities that are incidental to the operations of the business. They include such things as a gain or loss that occurs when an investment or a piece of equipment is sold. Also, when transactions occur in a different currency and the conversion back to the local currency generates a gain or loss, those are recorded on the income statement as well. The same holds true when financial instruments are recorded at one amount on purchase and then need to be adjusted to the current market value. Depending on accounting policies followed, the adjustment may be made as a gain or loss that will appear on the income statement. The statement of cash flows is the last statement that is prepared for a company. Using information from both the income statement and the balance sheet, it organizes all of the transactions that affect cash to arrive at the net cash movement for the company for the year. When the opening cash balance from the beginning of the year is added to the net cash movement, the closing cash balance will match the cash reflected on the balance sheet. The importance of the statement of cash flows is in understanding where cash is being generated and where it's being used in the business. The cash transactions on the statement of cash flows are sorted by activity type. Specifically, they are sorted by operating activities, investing activities, and financing activities. Operating activities relate to the day-to-day business operations, essentially the revenues and expenses that have been collected and paid during the year. Depreciation and amortization are not included, as these expense items have no effect on cash. Investing activities relate to the assets that support the business. Cash is used to purchase property, plant, and equipment, and is received on disposal. Other business acquisitions may also occur, which would be included in this category. A company needs to be investing in its business if it wants to remain viable and competitive. Financing activities relate to transactions regarding shares or debt. Essentially, if the company doesn't have enough cash generated through its operating activities to finance its investing activities, then it may be required to raise funds. A company raises funds either by borrowing or by issuing shares. To the extent that a company has excess cash, it may choose to pay down debt more quickly or repurchase its shares. The statement of cash flows can be prepared two different ways. It can be prepared using the direct method or by using the indirect method. The difference between the two methods is in how the cash flow from operating activities are derived. Regardless of which method is used, the results in cash flow from operating activities will be the same. In the direct method, the cash transactions themselves are the starting point for deriving operating activities. The cash transactions are grouped into classes where receipts are separate from disbursements. Examples of the classes include receipts from customers, disbursements to suppliers, and disbursements to employees, among other operating receipts and disbursements to arrive at operating cash flows. The remaining investing and financing activities are also grouped into related cash transactions, such as purchases and disposals of equipment for investing, and the issuance of shares and repayment of debt in the financing activities. All three cash flow streams are then netted to arrive at the net cash movement for the year. Under the indirect method, net income is used as the starting point for deriving operating activities. Any non-cash balances, like depreciation and amortization, for example, are added back. Changes in operating assets and liabilities, also known as working capital between the current and prior year, are also adjusted for. The working capital balances include accounts receivable, inventory, and accounts payable, and represent receipts from customers and disbursements to suppliers. Therefore, these adjustments are used simply to move the accrual basis financial information to cash basis financial information. Like the direct method, the remaining investing and financing activities are grouped into related cash transactions, such as purchases and disposals of equipment for investing and the issuance of shares and repayment of debt in the financing activities. All three cash flow streams are netted to arrive at the net cash movement for the year. Let's spend a few moments exploring the importance of the statement of cash flows by considering what the key elements tell us. First, consider the cash flows from operating activities. These cash flows represent the lifeblood of the company and are generally used to finance the investing activities of the company. The change in working capital is an indication of whether the company is managing its working capital wisely and financing its operating activities through the activities themselves, or if working capital is being loosely managed and causing a financial strain. The amount of investment in property, plant, and equipment is another key element. As mentioned previously, a company needs to continuously invest in the business if it wants to remain both viable and competitive. Finally, the financing activity section is an indication of whether the operating activities are providing enough cash for investing activities. A successful company may have surplus cash after investing activities that it may use to repurchase shares or pay down debt. Publicly traded companies and many other organizations publish an annual report at the end of their fiscal year. The annual report contains a large amount of significant financial and non-financial information. It's an important document for investors and creditors to learn more about the company's performance. It's also an opportunity for a company to not only report out on its operational and financial performance, but also to provide some insight into its strategic direction. An annual report for a publicly traded company will always include a letter to the shareholders, which acts as a sort of executive summary about the company's performance and future intentions. This is signed by the CEO. The chair of the board may also include a message specifically related to corporate governance as well. A description of the business, which outlines what activities the company is engaged in, management's discussion and analysis, or MD&A, which we'll cover in more detail next, reporting on internal controls over financial reporting to demonstrate that the internal controls have been designed and are operating effectively, an audit report if a company has been audited or another form of accountant's report if it hasn't, the financial statements and the accompanying notes to them, a breakdown of earnings per share, and finally, a listing of the directors and officers of the company. The Management Discussion and Analysis section, or MD&A, provides important information regarding the past performance and the future strategic direction of the company. The MD&A provides the financial highlights and is meant to be read as part of the overall financial reporting and acts as a sort of variance analysis, explaining why the company performed as it did and what future actions would be taken as a result of the performance. The MD&A also includes a description of the key risks facing the organization and how those risks are being mitigated or managed.